We're here because free speech is under attack. We're here because people are being convinced that socialism works. We're here because people are being judged guilty until proven innocent. We are fighting back with facts. This is not a safe zone, so buckle up, Buttercup. This is the raw, naked truth.
It's a roller coaster market, bear, bull, recession, what you need to know. This is the Raw Naked Truth. I'm your host, Eric Lopkin, and with me today is Brian Williams of Northshire Consulting for our Wallet Watch segment. Brian, how are you doing?
Doing just fine. Great to be on again. Thank you, Eric.
Great to have you. So, yeah, the last couple of weeks have been absolutely crazy in the market. Give us your point of view. What's been going on?
Well, I think you've seen a massive shift to some sort of normalization. So we've been in a period for a while with relatively very low interest rates. So it's been good for borrowers, for people taking out mortgages and refinancing, and it hasn't been so good for people who are savers or people who are in a retirement mode where they need income from their investments. Now we're seeing that sort of recalibrate a little bit. Interest rates are normalizing a little bit, and that's never a very fun experience. It can be pretty jarring, and but it's something that probably happens. So we're recalibrating all of the numbers and all of the spreadsheets. For a while, it was you had that cell on the spreadsheet, which was your borrowing cost, and everybody's kind of ignored that because it was pretty low or close to zero. And now it's like, oh, that's actually a big expense. And you've got companies that may have to refinance some debt, and now that's an issue. And people that were investing in fixed income securities just as a stability asset are now able to pull some income off. So it's good for them, but a lot of recalibration, I think, is probably the key here going into the fourth quarter.
So there's been a lot of talk about whether or not we're in a bear market. Uh, for those of our listeners who are not familiar with what that means, can you give them the definition of what a bear market is?
Yeah, definition of a bear market is when you're down 20% in the stock market from a previous high. So it's one of those things we talk about in the industry. I don't know if for John Q. Public or Jane Q. Public, if it matters if you're down 19.5 or 20.2, probably not. But the stock market is a lot like round numbers. We like to look at historical numbers and batting 300 or 62 homers or that kind of stuff. So we look at bear markets as being down 10, 20%. And it's just kind of something to talk about. But, we're definitely uh, off our peaks now significantly. And people who've had to deal with this, it's not comfortable. We talked a little bit about, before we started recording, about people who are approaching retirement or in their first few years of retirement, how stressful that's been. And a lot of folks have had to go back to work because you're dealing with the increase in all of your costs with inflation, but you're also dealing with calendar year 2022. You've got the stock and the bond market down significantly, which is extremely rare. So the confluence of those three issues have made it very difficult for pre-retirees and recent retirees, really.
So, what do you think is coming down the pipe? I mean, we've got, earnings will be coming out. We've got uh, the GDP numbers coming out soon. How can people deal with all of this?
Well, I think to look at a rosy picture, the good news is for folks that are investing in bonds or people who are putting some money to work, you're now actually able to get some return on those dollars. You go back, even a year or so, going out 2 years on a treasury bond or investing in two, three, four, five in that range, you're getting almost nothing, whereas now you're getting close to 4% on that money. So it may not feel good if you've got inflation running a lot higher, but at least you've got some money that's earning you some interest on new money. So that's a good thing. From a recession standpoint, I've seen a few surveys, and most CEOs, CFOs are calling for probably a recession in the first quarter of 2023. Some calling it in the second quarter 2023, but I think that's what a lot of folks have factored in. And really, that's not necessarily always a bad thing. I mean, that's what the Fed is trying to do when they raise interest rates. They're trying to slow the economy. So they're running that balance of trying to fight inflation, but not trying to have the economy and the stock market fall apart too. So it's a difficult balance, but hopefully they'll get through it okay.
Yeah, they're trying to manage a soft landing for the economy. Whether or not they can do it is anybody's guess. One last thing I just want to touch upon with stock prices falling as they are. Yeah, a lot of people tend to panic, but if you're not about to retire, this is not necessarily a bad thing. And can you explain the concept of dollar cost averaging to our listeners?
Sure. Yeah. The simple example of that is folks who are saving through a workplace retirement account, like a 401k, and they have money going in every couple weeks, every pay period. And when the stock market is a little bit higher, they're buying less for that same amount of money. And when the stock market's lower, they're buying more. So you have to sort of change that mindset. If you think about, let's say, in terms of gas prices, right? You're buying a lot less with $20 in gas than you were buying a couple years ago. So if you're on that same dollar amount, you're able to buy more as the market goes down. So it's actually a good thing. I mean, ideally, your ideal scenario is to have the market stay down the whole working career and then actually have it go up when you retire and, start to pull off the income. I mean, obviously that's your ideal scenario, but most people feel comfortable when the market's going up and their statement goes up every time. And we haven't really had a lot of down markets. You got somebody who's 40 years old now. They really haven't experienced any significant downturn. You're down about 39% in 2008. I mean, that's 14 years ago. A lot of those people were kind of just starting their career at that point. So from an education standpoint, you have to walk those people through it and tell them this is a normal adjustment. The price to earnings ratio, which is deciding whether the stock market is expensive or not, that's closer to historical averages. Your bond yields are more closer to historical averages. So that sort of recalibration and getting people back to normal numbers is probably a good thing. And dollar cost averaging, buying in over time, sort of evens out your price purchasing points for stocks in the stock market. So it's actually a good thing if you're in that accumulation phase to have the stock market go down a little bit.
Absolutely. Like any situation, there's the good with the bad. You have to take the entire picture into consideration. Well,
Absolutely.
thanks for being with us, Brian. That's the Raw Naked Truth. Catch every episode of the Raw Naked Truth at xvadio.com/podcasts, the Apple Podcasts app, Google Podcasts, Spotify, iHeartRadio, Stitcher, Amazon Music, Audible, and wherever you find podcasts. We'll see you next time.